episode of the Difficulty Adjustment Podcast. My name is Gustavo. I'm the co host, I'm the CEO and founder of Audio, and I'm joined by Claudia Sotomayor, Head of Operations at Audio 2. Claudia, would you like to say a few words?
Yes. Hello, everyone. Hola, Gustavo. It's Tuesday again. I love riding shotgun with you. And this has been a crazy week in the Bitcoin world. Like the charts are crazy. So I really want to dive into this with you. I have a lot of questions.
Excellent. This week, we're going to talk about the price action around Bitcoin. So, as you all might know, Bitcoin is right now around $79,000, up from 64,000 not even a week ago.
Right.
Why does this? We're gonna basically cover why does this happen? What is the relationship between the price of Bitcoin and the yield on the U.S. 30-year bond? But also what is the impact of the Treasury, Department of Treasury announcements on its debt buyback program, and how does that impact Bitcoin? So, and also, what is a lot of people have been talking about this, saying there's no demand for bonds. That is just not true. There is a lot of demand for bonds. The demand has simply shifted, and the behavior behind the people that are buying those bonds is also why we can explain what is happening. So let's jump right
Okay.
into it. Are you ready, Claudia?
I'm ready. And something that I thought is like maybe we should say list the price of Bitcoin at the beginning of each episode because like right now it's 78,700 and dollars, US dollars. And last week it was in the low 60s. So a lot has happened that the price indicates, right? Yes.
Totally.
So
That's exactly it. So now
mhm.
let's jump in on looking at the charts. So yeah, like you just said, we can begin by looking at the Bitcoin price chart. So Bitcoin is right now at $78,705. A bit down in the day. Yesterday it went up to 81,000 and it bounced
Mhm.
down, but it's still quite stable, way up from what we had seen over the past few weeks. I believe this is the highest in about since May. So a huge comeback very quickly. I think it was the biggest candle in Bitcoin history, the biggest weekly jump in Bitcoin history. So that was also fun to watch. And a lot of people wondered why did this happen, right? And then there were
Right.
theories around the fact that it was related to people getting their positions getting liquidated. But my theory, and what everyone seems to be now realizing, is that it's completely related to the price of the 30 yield bond. So, what happened exactly? As we know, as we might know, the 30-year bond has been going up over the past few years since a low in 2020. And of course, interest rates went up and that affected it. But the yield is now higher than what the US Treasury interest rate is at. Excuse me, the Fed interest rate is at. So now we have a 5.157, which hasn't been the price since at least 2004. Okay, so you got to go back as
Okay.
early as 2006, 2004. So at least a 20-year high on the US 30-year bond. And the yield going up, Kelly, can you mute yourself when you're not talking,
Oh.
please? And the price going up has pushed the Treasury Department to intervene, something that they had started doing 2 years ago. In 2024, the US Treasury announced that they were going to buy their debt back. This is the first time the US Treasury is buying its own debt since, excuse me, when the program started in 2024, it was the first time since 2003. For a short period between 2000 and the year 2003, they had bought about $75 billion worth of bonds. But the situation back then was very different. The US government had huge surpluses in the 2000s, in the early 2000s, and it was buying its bonds, its debt back through programs of fiscal surpluses from a strength position. Now it's buying its debt from a weak position where the government simply doesn't have surpluses at all. It hasn't had liabilities this high since at least Second World War II. Uh, Plus the fact that the debt is at a long time high too. So we don't have the same fiscal position. The United States doesn't have the same fiscal position it had in the early 2000s when it was the last time it was buying back its debt. And when was the time before the 2000s? You got to go back to 1930. So in the 1900s, it would also buy its bonds during periods of fiscal surpluses. 1930 is the last year they do that through the arrival of the Great Depression. They started for a brief time around 2000, and now they're back at it as of 2026, starting in 2024. And now, what they announced last week, which we can see was announced around the 19th of August, around 8 a.m., 8:50 a.m. Eastern time, what we see is that they're doubling the size of their buyback operations from 2 billion to at least $4 billion, right? And we can time that announcement with also the price action on the US 30 yield bond. As you can see, 19th August, early morning, 4 a.m. UTC -6. You can see the price drop of the 30-year yield bond. The yield drops, right? Because when the yield drops, it means the bond is going higher in value. The yield is always opposed to the bond value. The lower the bond is priced, the higher the yield to suffice investors of that bond. But if we look at the Bitcoin price, we also can find the same timestamp, 19th of August, 4 a.m. UTC -6, is also the hour right before the price goes up, and it just goes up and goes up, right? So clearly, we can see already from looking at the market price of the 30-year yield bond, and from also the Bitcoin price that there was price action around the time the news was announced. And shortly, a few days after, Bessent, the Secretary of Treasury Secretary, specified that he could tap near $1 trillion, excuse me, to fund bond buybacks from the Treasury General account. Okay, very careful to say that this is not the same as quantitative easing. This is also not money printing per se. This is money that the Treasury already has. But it is definitely the government intervening to control the yield on its 30-year debt. Shortly after the price went down, the yield went down. It went up again, but now it has come back, started coming down again. However, this is only based on the news, since the announcement says that the change in operations will only start on September 9th. So we still yet haven't seen the real effects of this change in policy, but we can already see how the market is perceiving it by looking at the 30-year yield and also at the Bitcoin price. So that is the news, Claudia. I want to stop there. I want to ask you if you have any questions. How clear was that?
So my understanding is that the 30-year bond actually determines a lot of different things, like mortgage rates, for example, which, I mean, the real estate market in America is like one of the biggest asset class in the United States, right? More than the stock market or the bond market even. So this affects, because many people would hear like, oh, bond or yield rates are up or this and that. It's like, oh, how does this affect me? And I'm like, well, actually, it affects your ability to get a loan. All kind credit card rates, everything. So what exactly does this mean? Because to me, I understand, okay, yields go up. That means the people don't want the bonds as much. And it's more expensive for the government to borrow money. And so they don't want the yield to go up because it's more expensive for the government to pay that later. So they have intervened to lower those rates by buying the bonds themselves. So the Treasury sells the bonds. Who's buying the bonds? The Treasury also? The Fed? Like, that's the part that I don't quite understand. And forgive my ignorance.
Yes. Okay. So thank you for asking that question. So when we're talking about this type of operations, we're not saying that the government is buying bonds from open sales, new bonds that are being sold. Okay, we're definitely not talking about that. We're talking about weekly purchases of off the run treasuries.
Okay.
So these mean treasuries that are in the open market, right? So
Okay.
very different from the Treasury or the Fed being the first to buy this, right? This is just a regularization program where the goal is not to replace the initial buyers, but to stabilize the yield price on the open market of long duration bonds that are currently being traded in the markets.
So let's say I have a Fidelity account, and in the past I used to. And I bought, when it was first issued, I bought a batch of 30-year bonds. And it hasn't been 30 years, it's only been a couple of years. But now I need the money, so I want to sell it. And the market for that was a little bit weak. And so the government is stepping in to buy them from me, not when it was first issued, but from people that already own it, investment funds or whoever that want to basically making the market a little bit liquid so the yield doesn't go up. Is that what you're saying?
That's exactly what I'm saying.
Okay.
So
Okay.
very important to differentiate this from quantitative easing, which is basically a modern way, a monetary policy to where the central bank will buy large amounts of government bonds to stimulate an economy, but also to print money. Right now, we're simply not. This is simply not a money mass expansion operation. It's more like an intervention by the Treasury to stabilize the yield on the market.
So the treasury that issued the bonds is now buying them back from the people that originally purchased them.
Yes, that's right.
Okay.
Yeah, so that's what's going on, right? And why is this such a big news? Well, because like I said, let's put it in a historical perspective, right?
So can I interject here? Because to
Yeah.
me, if let's use a real world example. Uh, Apple is very sticky with their margins and their prices. So let's say, okay, an iPhone is $1,000. Uh, so to keep the resale value of those iPhones, Apple is going into the market like eBay and the resale market basically and buying up used iPhones to make sure that like that image of the iPhone is not tarnished somehow after like faulty software or whatever. Like, you know what I'm saying? Like the manufacturer of the product is buying it
Right.
to prop up the reputation of it.
There's a difference because this is a fungible asset, right? Bonds are
Okay.
don't perish or don't depreciate in value like an iPhone does, right?
Right.
It's fungible. One bond exchange for another. So, but it's similar to a company buying its own stock to intervene in the price of that stock, right?
Okay.
So it's
The
similar in
but
that sense.
yes, that's actually a better example. You're right. Way better example. The difference to me though is that my understanding is that the US government doesn't actually have a treasury, right? We've been running deficits for decades now. And our debt is in the high 30s of trillions of dollars. So there is no like money saved up. The money that they're gonna use for this is fresh new money, I'm assuming. Like it's not like we have a savings account underneath the mattress.
Excuse me, I'm not sure what was the question.
So what I'm saying is like unlike a company stock buyback program. Usually when a company buys back their own stock, is they have cash laying around.
Right.
And so they buy back their own stock, right? That makes sense to me. But in the case of the US government, if the US government is a company, like they have no rainy day fund or emergency fund or savings, in the sense that we've been running deficits for decades and the debt is in the 30 plus trillions of dollars. So where is the money coming from to be buying these things if we don't actually have savings?
Well, the technically the treasury does have some savings, right? But yeah, in
Okay.
the end, once it runs out of those savings, it has to print money to be able to continue this. Either that or reprice the currency lower, which I'm gonna get that to a second, right?
Okay.
So
Okay.
there are like the US Treasury Department is a very strong global institution that has many tools in its toolbox. This is just one of them. We're very far away from a catastrophic scenario. But definitely there's signs where policy is starting to get dictated by the market, right? If the market priced 30 years bond yield higher, it reprices the US debt higher at a higher yield. It removes their control of how much they can grow the expenses in the US federal government, um, how much they can grow the deficit, how much money they can spend, right? What they can spend it on. Definitely, the market is putting a check for one of the first times in global history. They're putting a check on the U.S. government and basically saying to it, "We're gonna buy your debt, yes, but we're gonna buy it with a higher yield because the risk is higher, right?" And
Okay.
every further fiscal action of the US government and also the US economy can have an impact in that yield, right? And
Mhm.
now policy is basically being dictated by the market rather than being fully free as it has always been.
Okay. And this is all like organic. It's not like one credit agency downgraded US bonds or something. It's just organic market demand for US bonds is drying up.
No, that's what I'm saying. The demand
Okay.
is not drying up. I'm gonna get to
Okay.
that in a second. Okay,
Okay.
maybe
Sorry.
we
Go
should
ahead. Go
just
ahead.
talk about that. So I did a whole analysis where I looked at the 30-year history of all latest bond purchases. Okay, so and these are the 10 biggest takeaways. So if we look at long nominal treasuries, so long duration ones, we see that the buyer base has shifted from treasury dealers into investment funds. Okay, this is an enormous structural transformation, right? Where
I see.
in the
Like
past,
massive. Yeah.
massive, right? So, and that is what is happening here. The new buyers are a new sort of buyer that is way more sensitive to the yield price reflection, right? So, and that is really what's going on here. So the scale, we can also call it the scalable marginal absorber of treasury durations, has migrated from dealer balance sheets to the investment fund complex. And there's simply no evidence of a foreign buyer strike or simply a buyer strike, right? Foreign governments are still buying bonds at the same rate as they have over the past 25 years. Okay, so foreigners are simply, it's not true that people are refusing to finance the United States, right? Um,
Okay.
Even clearer, foreigners are buying vastly more treasury duration than they used to. Okay, so they're signing up to buy way more long nominal public issuance. However, we can now see that this makes price sensitive more important than buyer disappearance. This is my point, okay? The
Okay.
point is that the treasuries continue clearing, but increasingly have to compete for globally mobile capital on price because there's a new buyer and the buyer is more sensitive to the price. So the buyer, there's other assets that are competing with US 30-year bonds. And that is what is pricing the yield higher, right? Because the new buyer is simply more price sensitive.
Okay. Uh, okay, that makes sense to me. I mean, investment funds have a fiduciary duty to their clients, so I would expect them to be price sensitive if they are the main client of the main purchaser of bonds.
Exactly.
Yeah.
So, how historic is this, right? This is what I was saying at the beginning, and this is something else that I have from my research here, is that um, I asked the question: is this the first time the U.S. government is buying back its own bonds since 1930, except for the 2000s when the U.S. had fiscal surpluses? And the reality is basically yes. Okay, so like before, throughout 1930, it was mostly debt retirement during periods of sustained surpluses. So once again, like you were saying at the beginning, you would usually do this if you have a lot of savings. You would buy back your stock. You would buy back your bonds. And this was historically the case. 1931, 1999, zero, no treasury buyback operations. In 2000, it starts because the US has its best fiscal position in decades, right? So the federal government was running surpluses and debt outstanding was shrinking. So they were buying back their debt. This was very positive. It was a very good fiscal moment in the United States. The Bill Clinton administration is historically recognized as the best fiscal period in modern, or maybe even economic period in contemporary U.S. history, right? Then there's a pause for 10 years, and then it comes back in 2014 to 2023. But these are operational readiness tests, very small amounts, simply testing the operations, testing the market. Probably in expectation that eventually they would have to do regular large scale programs, right? The 10-year preparation is simply a lead up to what they can predict will happen in the 2020s, which is large scale programs, right? And that started in May 2024 under the Biden administration. And now the Trump administration is doubling the size of those operations and expanding the program. Okay, so yes, you are completely right that this is a historical anomaly in the sense that the government usually buys back its own debt when it has fiscal surpluses. It will rarely do so when, as of right now, the US debt is massive, the fiscal deficit is massive. It will rarely do that in those times, right? So that is the historical reality of this, and which is why it has so much impact on markets as a whole, but on Bitcoin specifically, because the whole point of Bitcoin is for it to be a hedge against the current monetary system, which is clearly showing a lot of weaknesses.
Right. This is, to me, this doesn't inspire confidence in US debt at all. Like if the Treasury has to step in to buy their own product.
Of course, it doesn't,
Right.
right? However, like I showed with the data, it's not
Hmm.
like people are disappearing from bond
Mm.
purchases, right?
Right.
A U.S. bond remains one of the best investments in the world, one of the safest assets.
Hmm.
But definitely, the buyer is just signaling, "I will keep buying your debt, but let's price the yield higher. If I'm going to take this risk,
Right.
I want to get paid more."
Right. I mean, this is my own bias. Like, I thought maybe in the past, people maybe were more willing to take a smaller yield or more expensive bond, for example, just because it's an American bond and there's a, I don't know, like a guarantee there, like a solidity to it. And now it's just more like any other country bond. And so you're not really looking at what country it's from, you're just looking at the number, the percentage. Uh, that's it. And so
Exactly.
that American shiny premium is wearing off, so to
That's
speak.
exactly what's happening, right?
Mm.
But not because foreign participation has decreased, but because uh, investment funds are now the biggest buyer and they're more price sensitive, right? So it's not so much that the it's two things at the same time. Yes, the U.S. fiscal position has weakened with so much debt, so many deficits, so many issues internally, but at the same time, you also have just a change in who's buying these bonds, and that's and these this new buyer is more price sensitive.
But investment funds are, correct me if I'm wrong, they are, depending on what kind of fund it is, right? They are mandated by law to have a certain amount of bonds, correct? Like if it's a retirement fund, it's like, oh, it has to be 20% bonds. Uh, Obviously, they don't have to buy US bonds. They can buy bonds from anywhere in the world, but it has to be bonds. So that's what you're saying. Like, yes, they are mandated to buy bonds. It's not like they can just swap bonds for stock or something else. They have to stick with the category, but US bonds are just not as competitive. So they're switching to other bonds, not American ones. Okay.
Right, exactly. Right, they're just
Mhm.
comparing the yields of different types of bonds. You no longer get exception of of competing with other types of bonds just because you are the U.S. bond, right? So a good conclusion for me looking at all this data, because initially my reaction was that, well, demand for the bonds has to be decreasing in order for it to be for them to be panicking and intervening on the markets. And no, not necessarily, right? The reality is the United States is simply not experiencing a treasury buyer strike. That is simply not true. Quite the opposite, almost. Like the treasury has and the global dollar system has demonstrated extraordinary capacity to absorb changes in who's buying these bonds, but also the duration issuance of the bonds, because also from the data I showed, bonds used to be way more short term. Now they're very long term. That proportion has also shifted, and the Treasury and the global dollar system have been able to manage that correctly, right? But the mechanism has changed radically. Treasury duration is increasingly held by investment funds rather than dealer balance sheets, while foreign participation has remained stable. Of course, at the same time, US fiscal burdens are historically elevated, and alternative system optionality has increased, which is why there's also more competition, right? And the yield reflects that competition. Of course, the dollar dominance hasn't failed. Dollars remain 89% of all foreign exchange transactions. 25 years ago it was 89.5, and today it's 89.7. So it hasn't there's simply no change in how much interest there is for dollars in foreign exchange operations. Yes, there's a decrease in how much dollars are kept in central bank reserves from 70% to 57 in 25 years. But the dollar system remains king and remains unthreatened when you look at these numbers over a long-term period. However, the fiscal burdens are now showing when an investment fund, who is now the new big buyer, is considering the purchase of these bonds. They're just repricing the yield, adjusting it to the real risk return reality.
Okay. Okay. I get the picture, right? There's forex, there's reserves, and then there's the bond market, bond buying. So all of these things are pillars to the dollar. And the however, like forex is just people trying to skim off the top, right? Between the fiscal policy of different countries, or monetary policy, I mean, of different countries. So it doesn't necessarily tell you that the dollar is strong just because it's 89% of like forex trades.
No, forex is
Right.
all foreign exchange currency market. So when, for example,
Right.
I send you $1 billion from Mexico to the United States, that's a forex transaction.
Right.
When the bank
Right.
converts dollars to pesos, so it does show that the dollars remain in almost all transactions where a currency is traded for another. A dollar is one of the
One side of the
players.
trade. Got it.
Exactly.
Got it.
So
So
dollars are
is
extremely present in global
uh,
commerce.
okay. So that 89% figure is a reflective of trade more than just randomly
Exactly.
trading euros and dollars, for example. Okay.
Excuse me. But yes, precisely.
Bless you. Bless you.
Thank you.
Okay.
Precisely. Okay, so just want to clarify earlier when I showed some numbers where I was
Mhm.
basically saying that the buyers for long nominal treasuries in the year 2000, it was 79% dealers, and today dealers only represent 13%, where investment funds used to represent 8% and now they represent 71%. Um, so, what is a dealer? A dealer is an intermediary or a market maker. It's a large bank or a securities dealer. They often buy the treasuries first and distribute them later. So, dealers have simply shifted away from that strategy. At least they have decreased their position, their proportion considerably. Dealers used to take down a huge share at the auction itself, often because they just wanted to resell them. There was a huge market for them to resell them. However, the dealers have basically disappeared or reduced considerably when in the auctions themselves of these bonds, right? And now funds increasingly show up instead of relying on dealers' balance sheets to warehouse and intermediate the issuance. Funds will directly buy the auction itself, and they're way more price sensitive. So I think that is well understood now, and I think we've covered a bit around that news and that idea. I want to jump into the next uh, part of that, is that at the same time, very boldly, Scott Bessent is also announcing that after having dismantled Iran's military capabilities, destroying nearly 100% of their military factories and buried its nuclear program. This is said by the Trump administration, but this is simply absolutely false. Iran doesn't have nearly 100% of its military factories destroyed. It's simply not true. But now they say they begin an economic D Day, the greatest financial offensive ever marshaled against an adversary. So the Iranian Islamic Republic is now going to get massively targeted, or is getting threatened. And this seems like a huge threat, right? Until you recognize that nothing has really happened. Even a reporter asked Besson, you described this as an economic D Day, but D Day wasn't a threat. And the US didn't give a timeline to Germany. So why not impose the sanctions today? And Besson replies, why would I want to blow up the global financial system? So clearly they're playing chicken. They're trying to force Iran into conceding. But as we've seen over the past 6 months already, since the war started, Iran has never conceded because it simply doesn't have a weak position. And further sanctions on Iran would probably be limited in their impact, unless they started going after China and other countries that do business with Iran, which they have
Mhm.
signaled as something they want to do. But then they're probably too scared to take serious
Mhm.
action because of implications in the global financial markets. As he
Yeah.
recognized when asked, "Why don't you do it today?" he basically replies, "It would be too catastrophic." Right. So
Right.
we'll see what happens then, but definitely a lot of action from the U.S. Treasury this week with both the
Mhm.
economic D-Day threat and the
Mhm.
bond buyback program
I
doubling down.
mean, that to me sounds it's like all bark and no bite because Iran is already a sanctioned country. So what more? I mean, for years now. So I know pain can always increase. We can, of course, do more sanctions on them, but they already sanctioned. Like, what more can we do here theoretically, from an economic standpoint? Like, what other uh, monetary weapons could we use against Iran? That's what I don't understand. Like, why would they be scared
So
by some D-Day
sanctioning, no,
situation?
but it's mainly a threat against allies, people that do business with Iran. For
Uh-huh.
example, the UAE, which is at war with Iran, over the past few days or over the past 6 months, announced 5 days ago that coincidentally, the same day that the bond buyback program was doubled in size, the same day UAE suspends all trades and financial transactions with Iran. So and then they announced the economic D-Day, right? Is this a coincidence that on the same day of the bond buyback program, the UAE announced suspending all trades and financial transactions with Iran? Right. The point here of this economic D-Day threat is to get countries in the middle, even those that are at war with Iran. I was surprised to know that the UAE still did a huge amount of trade with Iran, but they do. But they're pulling back, right? So that is the threat here. In my opinion, the United States was simply unable to make to submit Iran through military means. So now it's employing financial means. However, in my opinion, this further reinforces people moving away from the dollar system. So you're pushing allies away, or middle countries that are between the let's say the axis, Iran and its allies, and Washington and its allies, right? So definitely this could have a blowback effect, where we could also observe this pushing other countries away from the US and away from the dollar system, rather than doing the intended goal, which is to seclude and isolate Iran. So I expect more countries to take positions here, such as suspending all trade and financial transactions with Iran, as the UAE did. But I also expect some other countries to question themselves on how reliant they want to be with the dollar system, because today it could be Iran, tomorrow it could be another country, right? So
Right.
so that is how I see this, and the timing is also very curious. Why do this on the same or at the same time? Probably it's an expect. In my opinion,
Mhm.
Treasury is expecting more pressure on on the yield pricing from these military actions, or almost financial warfare actions it's going to take. It expects markets to react negatively to its yield and its bond price, which is why it's also positioning to increase their bond buyback programs in preparation for a blowback from the economic warfare they're trying to fight, because they're unable
Right.
to submit their enemy through military means.
Correct. So they are exhausting other non-military weapons, definitely, right? And I mean, Teddy Roosevelt was the one that used to say, "Speak softly and carry a big stick," right? And the big stick here is the financial system, and the U.S. has no hesitation using it against people that they don't agree with. However, I see that in the past few decades, the effectiveness of that is not what it used to be. I mean, we imposed all kinds of sanctions on Russia. McDonald's pulled out, Facebook pulled out, all of this, and I mean, Russia's still there, right? Um, so I'm not sure how effective that would be against Iran, in the sense that I see that they're basically forcing people that trade with Iran to take a side and break economic ties with them. Sounds like that, right? So further isolate Iran. And so if you're a small country and you trade with them, it's sort of like, okay, the US is asking me not to do business with Iran. Who am I gonna do business with? Like if you're taking my customer away from me, are you replacing it with a different one? Um, how willing are other people to do that? I don't know. And I mean, is China gonna do that? I don't think so.
Right.
So
That's exactly it. Is China gonna get influenced by this? Probably not, right? And probably that's why this mission will fail, because Iran's biggest oil trading partner is China by far. So if yeah, they can maybe get countries like the UAE, which are very US aligned and even militarily opposed to Iran. So we will probably get some signaling from some countries, which obviously they would just side with the US. But those that really matter, like China, are probably simply going to ignore the offer. And can the US Treasury sanction a Chinese bank? That is the question, right? And what
right.
does that entail, right? Because as we saw last year, on what Trump calls Liberation Day, after
Mhm.
starting a trade war with China, he simply backed out a few months later and basically arrived at a halt. There's a bit of a resolution, or at least a pause, in the trade war between the US and China after China threatened the rare earth minerals
Right.
supply the US needs, right? So,
Right.
once again, does this actually get China to turn against Iran, or it's simply, or they can simply reply and the US will pull back? But
Mm.
I think it's all like very. Of course, I'm very interested in this topic, but I think it's all signaling to the market that investments assets like Bitcoin are definitely more interesting under these news, right? Whether it's the geopolitical clash between Iran and the United States, but also now the actions the Treasury is taking on the bond markets. And there's even speculation on the longer term, right? So, for example, I follow this guy called, I believe his name is Jeff Park, and he's a partner at Powerfy Capital, but he used to be an advisor at Bitwise. So, what he says is um, that the next step is basically going to be what he calls a Plaza Accords 2.0. Okay, so in his opinion, everything the Trump administration is doing is it will end up in a sort of Plaza Accords 2.0. From
Mhm.
Trump and Bessent clashing earlier on in his administration, from Myran, who I believe is subsecretary of Treasury or a position similar, who basically
Mhm.
says the US government is suffering from its global currency reserve status position. And because Myron points out that there's some benefits to being the global reserve currency, but there's also some downsides. So that was also a very interesting thing that was said last week, right? And then markets will crap out. Fed will be forced to play the tiles. He says we've already been undergoing this, and US will realize almost TGA not enough to defend 30 years. So this was written more than a year ago, and a few days he's like, we're at step five, right? Because yes, now they're
Wow.
defending the 30-year bond after everything else was tried, and they
Mhm.
will probably realize this is not enough, and then is when the Plaza Accord 2.0 comes in,
So hold on,
which
hold on, hold
yeah.
on, hold on. Sorry, you're going very fast. What is OMO and TGA?
I forgot exactly what it stands for, but basically he's talking about the bond buyback programs.
Okay. And Miran is he's in the Federal Reserve. Okay.
Yeah, TGA is Treasury General Account. So
Okay. All right.
the Treasury, like I told you, they have some savings, and it's about $1 trillion.
Mhm.
So
Which
it's
right, which is what Besant said. Like I have up to a 1T to spend on this.
exactly, Jeff Park is basically
Okay.
predicting they're gonna
Uh-huh.
realize they're not able to defend the yield, even by spending all that money,
Oh my
right?
God, this is I don't know why how people can watch like soap operas. This is like the most drama to me. Like what the situation with the 30-year bond. I mean, the 30-year. If we cannot defend, if the United States cannot defend the 30-year bond, it's basically like the economy just totally collapses.
So
Okay.
tell the story about the mandibles.
So that I mean, I was telling you before, like I get goosebumps reading this news about the 30-year bond and the U.S. trying to defend it and the yields going up. This is exactly how that novel starts. And the Mandibles, I forget the name of the author. It escapes me, but she knows a lot about economics. And anyway, in that book, which is fictional, but reality seems to be uh, following exactly her art. In that book, basically, it starts out with these types of news, and it's breaking news. The 30-year bond the yield is just going up and up and up, and the US is unable to defend it. The US employs all kinds of different methods to try to bring the yield down. And it's just like, yeah, runaway inflation at that point. And the rest of the world, like the BRIC countries, create their own currency called the Bancor, and the US is left out. And basically, the US becomes a country just like any other country because they lose their reserve currency status. And now Americans lose their exceptionalism, basically. And and they have to basically deal with all the I don't know, the difficulties and the frictions that the rest of the world has to deal with, that as an American you don't have to face. And all of that starts with the bond market, the yields not being able to be defended. And anyway, yeah, we're living that now. It seems like it's not something that happens in a day. I understand, but the drums, like you can hear it, like getting closer.
Right.
That's it.
Totally. And this is specifically related to the trifling dilemma, right? As you are the trifling dilemma, or the trifling paradox, is the conflict of economic interest that arises between the short-term domestic and long-term international objectives when you are the country that serves the global reserve currency. Okay, the dilemma is that if you're the global reserve currency, it means other countries are buying your debt, and it means that you can run constant fiscal deficits, which will shift you in a long-term worse position, right? Which is exactly where the U.S. stands right now, with fiscal deficits, massive debt. But also, it's that when, in order to support international trade, other countries hold your reserves. This will also lead to inevitable trade deficits, where other
Mhm.
countries, and this is exactly how Trump came into power, right? This is exactly what happened, because the United States runs tremendous trade deficits with other countries. The manufacturing is no longer based in the United States. The United States has basically, having the reserve currency basically turns you into a financial, technological state. It removes all your physical assets away from your country, and then it creates this perverse set of incentives, where you are spending way too much money, and with time you lose trust from the market. And the US is exactly in the trifling dilemma position, right? Clearly, it has lost a lot of its physical assets. Manufacturing has moved to Asia. Clearly, it has a very bad fiscal position and a very hard political way out of that fiscal position. And also, it remains the global reserve currency. So, like, but remaining the global reserve currency is incentivizing itself to run further trade deficits, which means that manufacturing is simply not going to come back. Why? Because the currency, when others buy your currency is valued higher. If your currency is valued higher, people don't want to buy your goods because your goods are too expensive. So goods get produced elsewhere, and you become a sort of financial technological state, which is what has happened with the United States, right? So, what is and the question here is there a way into, does the US have to abandon its global reserve currency system? Well, what someone from the Trump administration, like Myran, said is that they don't want to abandon the Stephen Myran says, who was a Fed member, but he was also chair of the Council of Economic Advisors to the president. What he basically said is that, we don't necessarily want to give up the reserve status because it gives us huge benefits, but we want other countries to pay the price. We don't want to be the only ones paying the price of the fact that we run the system, which is what led naturally to the trade wars. Right now, if you look at it from that perspective, I think every action from the Trump administration makes more sense. Basically, my Iran speech last year and the U.S. National security strategy are like the two most important documents or speeches of this administration. Because, yeah, okay, Trump tried to make other countries pay the price with the tariff war. It's like, okay, well, you're just going to pay me tariffs if I'm going to have these huge trade deficits, or I'm going to impose tariffs to impose a cost on your manufacturing, on your exports, so that my exports can be more competitive. But what a guy like Jeff Parks says is that we don't have a choice. We will, but to end up in a Plaza Accord 2.0 type, which what the Plaza Accord was in 1985. The countries got together, the United States and Japan and Germany got together, where they all agreed into reducing the value of the US dollar, right? So the US dollar was um, heavily depreciated in value, or devalued, so that the US could be more competitive in its um, when for commerce, right? And this led to the Japanese asset price bubble of the 1980s. A lot of things happened after that, but yeah, the US dollar was depreciated against the French franc, the German Deutschmark, the Japanese yen, and the British pound sterling. So what a guy like Jeff Park is saying is that the US will simply have no choice but to depreciate its currency considerably, and that will lead to a run up in Bitcoin's price. Yeah, that's the theory.
This is fascinating. Okay, I had not heard about that before, the Plaza Accord. Uh, but it makes perfect sense. Many people would say like, "Oh, Trump this, Trump that." Like these tariffs seem to have come totally out of left field and so arbitrary. But really, like they're trying to bring balance into a system that is increasingly dysfunctional. And that's just one of the tools. Okay, they were ruled unconstitutional, this and that, and okay, that tool is out of the equation now. Now they're trying out other methods, but it's they're between a rock and a hard place. It's not easy what they're trying to do. Like sometimes I wonder, Gustavo, if you were uh, okay, you don't have to answer this question, but if you were the Secretary of Treasury, or if you were in a position to make these fiscal policy decisions or monetary policy decisions, what would you be doing?
Well,
Like,
if I was dictating,
would you try to save the dollar, or would you just, I mean, let it die? Like,
well, like depreciated,
yeah,
depreciated versus try to save it. Well, of course, the answer is very simple. You reduce spending, but that's simply never gonna happen, right? Which is why the only reason why we get into this problem is because the fiscal situation doesn't allow us for an alternative, which is because no administration, whether it's Republicans or Democrats, are going to cut expenses, right? They're simply going to increase spending, increase the deficit, increase the debt, right? So an alternative is to lower interest rates. But if you lower it, because then your debt and your
it gets
yield
cheaper.
go down, right? Your
Mhm.
debt payback. However, you will have to deal with massive inflation if you cut rates. So this is a classic monetary historical position where you're cornered, where politically you cannot cut spending politically. There's simply no way you will win the next election by cutting spending. You will simply not, and like either on the like social benefit side, it's a political suicide, but on the military side, it's a geopolitical suicide, right? So there's no cutting any spending anywhere. It seems. The other answer is, will I try to? What about increasing revenue, right? And that is definitely something that has been tried. And like the tech sector grows a lot, right? And we have there's definitely like revenue from the tech sector, but once again, it's not enough. And the growth of the tech sector, which is basically one of the only growths tech sectors that is growing in America today, and has grown since the 2008 crisis, all that simply creates more political friction, because you have all these tech people getting wealthy, and the people that own the assets get wealthy, while other Americans feel left out, and it increases the political tension, which reduces your ability to reduce spending even more, right? So yeah, increase expenses through some revenues of specialized sectors creates more political clash and reduces your ability to reduce spending and forces you to spend even more, right? Militarily, same thing, right? You want to defend the dollar system, the global system. Well, you got to spend more militarily, but that also like clashes against your fiscal objectives, right? There's the theory of some tech people that say we're going to have so much growth in the tech sector, it's going to pay back the debt in years. That is absolutely like with AI, there was some hope at the beginning where this could happen. I don't think it's
Mhm.
realistic at all. So if I was a dictator, I would simply cut spending tremendously by like
Okay.
50%, right?
Mhm.
Would that require me abandoning the geopolitical status of the United States? Probably, right? There's probably no way
Mhm.
around cutting spending where you basically decrease. So yeah, what I'm saying is that I don't see a way out. Okay, like okay, so what is? I also did this full analysis, right? Because I was really questioning myself this past week with all the changing narratives we've seen, right? And I started to look at the data, and the reality is that the U.S. remains central to three pillars of its power. The first one is the dollar as part of the as the reserve currency or the main currency being used in trade globally. That is very stable, right? Dollars, like I said, remain 90% of all foreign currency transactions, at least one pair on each trade, on each transaction. On the second front is the reserves of the central banks. Yes, it was 70% 25 years ago. It's still like 57. It's still very strong. It's up even up from last year. So definitely a bit of signs of weakening, but definitely nothing very risky. Another question is capital, right? If you have $1 billion, and you're a Saudi family, you want to invest it in China or you want to invest in the United States? You want to invest in the United States. Well, first, because the United States has capital markets that, of course, the global reserve currency status allows it to have these capital markets so solidly, right? So there is that is related, but also the US has great judicial institutions, a lot of legal precedent, legal structures, startup talent, right? Financial institutions. So the whole plus, but I would say the main asset there is the legal precedent and the judicial institutions, right? If you invest in the United States, you know you're investing in a fair game. If you invest in China, maybe your money will be very profitable and productive because China has a lot of physical assets, but you are complying to the rules and it's not a fair game, right? So it remains clear that if you are a sovereign fund and you want to invest your money outside of your country, the US is the primary destination, right? And that is also a massive source of the US power, right? And that there's no signs of that changing too. Could there be a suddenly, gradually moment where these things change quickly? Maybe. But I think politically, unless there's a massive political issue where Trump forces himself into a third term, or a communist wins and he changes things, or someone gets removed from U.S. power from the U.S. presidency, which changes the legal trust, which I don't think
Yeah.
are things that are highly likelihood of happening, then I think the legal and the judicial standing of the U.S. as a country of rule of law continues, right? And that remains, and it remains the main destination for global capital. The third argument for U.S. Hegemony remains military superiority. The U.S. spends more than like the next 20 countries combined militarily. The U.S.
Right.
supplies weapons to a bunch of countries. So, for example, even if a country is buying a lot of goods from China, for example, it doesn't mean that it's not buying weapons from the United States, right? So,
Right. Right.
the U.S. remains the main supplier of weapons for most countries, or at least most important countries, right? But that is also changing. For example, if we look, but yeah, so I wanted to say that like the U.S. remains very strong on these things, but we're seeing pressure all aboard, right? On the military front, the Iran war is definitely a huge pressure and definitely showing weaknesses from the U.S. Military system, right? Also, weapons are changing, right? Small, long-range drones.
War is changing. Like
Exactly.
how we do war is changing, and to me, like the US is designed to perform and do war in a particular way. uh I don't know, I mean, I'm not a military expert, but I see what Ukraine is doing and what Iran is doing, and like we're not really equipped to fight that kind of war. I mean, does the US have like drone making operations? Sure, we have the Raptor and the Titan, I think, and but those are like really big drones, more for surveillance, not for like little guerrilla type warfare stuff. Um, so this whole threats from Besant for Iran, like this economical D-Day, I really see this as bark. Maybe I'm wrong. Like bark and no bite. They're trying to buy time to do something, because what they're doing now is not working. They're not advancing. Iran is not going anywhere, and yeah, they're trying to shift strategy and buying time in the meantime with keeping the fight alive. Hey, like still sending threats, but they don't really mean anything. Iran is winning.
Iran wins by not losing. Okay,
Right.
when you are the superior military power, if you don't win quickly, you lose. Right, particularly when the U.S. population doesn't want a war in Iran. Absolutely doesn't want boots on the ground. But the Iranian population, which get bumped from time to time. Right now, there's a break. They're willing to lose it all, right? So it's also about that. It's also about the position of the countries. One is the hegemony country in the world. The other is just middle power, and also how ready the populations are. Also, like the systems. Iran doesn't care about what its population thinks when it wants to go to war. The U.S. cares so much. We have a midterm election in about 2 months, right? So also big difference there. I want to, yeah.
Yeah.
Please go ahead.
And that Iran is defending their homeland. I mean, they're fighting in their soil. Like the US is on the other side of the world. And like the motivations are different, you know?
Totally.
Um uh and I don't know. I didn't We'll see how this plays out. Like this Iran situation could have like very severe political repercussions here, right? Like total, like basically take a massive left turn in the midterms or in 2 years. We'll see.
Right. 100%.
Mm.
We already started to see it with the primaries. So I would just want to finish by saying that like my thesis is evolving in the sense that I don't think that the US is on the brink of collapse, or even it doesn't, no data demonstrates that, right? But its position in the world is changing and has been changing for a few years. So if you look at the alternative physical capacity, what does that mean? Where countries can just buy goods from other countries than the US Western system, right? Do countries have an optionality when it comes to manufactured exports or even military exports than they did 20, 30 years ago? The reality is that 20, 30 years ago, China represented 4% of global manufactured goods, when now they're close to 20 to 25%. Okay, so this is just one country out of the bunch, right? If we look at how much money does the US or China invest in research and development, China's always tagged as a country that steals intellectual property from the US. And yeah, for a long time, that's what they did. But the reality is that if you compare on a power purchasing parity, China now, this year, officially spends more than the United States does in research and development, north of $950 billion. Okay, so China spends more in research and development. China has a bigger manufacturing uh, export system than the United States has. Military spending, yeah, the US spends way more than China still, but how much is that proportion? In the year 2000, China was 7% of US military spending. This year, it's 40%. How much longer until China spends as much as the US militarily? 1, 2 decades, right? So if we look at how countries are, and that is simply talking about China, but like my thesis is also not China's going to replace the United States. We are clearly shifting to a multipolar world order. We're already there in multiple ways, and one of those ways is the physical reality, right? What gets produced where, and the countries have optionality outside of the U.S. Western system, and when it comes to physical resources, that chasm has already been crossed. It got crossed about 5, 10, 7 years ago. The US and the West simply don't have any more the monopoly or the superior position when it comes to
Right.
manufacturing goods and
Right.
physical production, right? However, monetary diversification is extremely slower, right? Like I said, the US remains the main
Mhm.
reserve asset. It remains the main currency being used in foreign transactions. Even like China represents 4% of international currency trade. Okay, so less than 4%. So absolutely nothing when it comes to that. However, this is a very interesting question. I studied this. It's how many systems, our countries are the middle countries, because who's going to make the difference here? The middle countries, right? Which means Brazil, Mexico, Saudi Arabia, India, Indonesia, all these 15, Turkey, these 15 middle countries are going to determine how the world shifts. And
Right.
they have been spending the last 15 years building alternative rails. This is very interesting.
Alter,
93%,
alter, alternative payment rails to trade with each other.
exactly.
Okay.
And at institutional levels, right? I'm not talking
Hmm.
necessarily about banking, consumer products. I'm talking about
Hmm.
institutional infrastructure. 94% of the 13 countries that I sampled already have a two alternative system pillar. 70% have at least three pillars. And these systems are not yet massively used because, like I said, most of the trade still moves via the dollar system, and the dollar remains the main asset. But 20 years ago, if they wanted to out exit the dollar system, they couldn't. Today,
Hmm.
they can. Today, they
Hmm.
have the infrastructure that allows them to move away from the dollar. So, my theory is that it's very likely that they're going to make the move when
Hmm.
things start shifting militarily,
Yeah.
geopolitically, right? And Besant announcing an economic D-Day and starting to threaten to sanction other countries simply pushes people into building these alternative systems even more or to increase their usage. For example, if we look at Indonesia, the Indonesia local currency transaction volume, um, in 2018, it was $350 million. Today, it's $26 billion. So just Indonesia's local currency transaction volume has grown by 74x in the last 7 years. Okay, so that is exponential growth. That is already not yet, that is definitely not the majority of the capacity, but it's showing that these alternative financial institutional networks and systems are there, and they're increasing in usage considerably, even exponentially, right? So
Okay.
they remain a minority, but it would just be very interesting to see that if the US keeps pushing countries away from the dollar, if the dollar system becomes riskier, countries are ready to make the switch.
So let me ask you a question about this actually. So, for instance, today is August 25th. Yesterday, my mom went to the bank and deposited a check of her own money into her own bank. Okay, like two banks. And they said that the money was going to become available August 29 at the earliest, basically like 4 days. Okay. I have never deposited a check in Mexico, but the reason my mom is doing this check thing is because that is faster than sending an electronic funds transfer from one bank to the other. Okay. And I know that in Mexico, like that happens immediately. It's called SPAY. And in Turkey, it's called an EFT, electronic fund transfer. They also have another one called FAST. And so, is this what you're talking about? Like the SPAY type or the SPEED, which is another system, infrastructure within one country, then interfacing with the internal infrastructure of another country, basically. So, everybody, all these middle countries have developed their own financial rails. And then now they're testing or building that interface to touch with each other. Is that what you're talking about here? Or no, totally separate.
Sort of. Okay.
Mhm.
I would say not necessarily because these are consumer networks. Okay. I'm not talking
Yeah,
about consumer networks. I'm talking about institutional networks.
like
If
a wire.
this, like you could say like an international wire, but that is even a consumer network too. Like that's not
Okay.
how central banks move money between themselves. They have these
Okay.
institutional systems for countries and central banks to move money. For example, I'm going
Okay.
to take the example of what's called the local currency transaction framework is a monetary agreement between countries um, that lets businesses and individuals trade and invest using their own domestic currencies instead of converting through the US dollar. For example, what I was describing about Indonesia, it's a system between Indonesia, Malaysia, excuse me, and Thailand. Okay,
Okay.
that system, which yeah, it is open to the public or to businesses. So yeah, it is a bit with what you were going, but it's also requires bilateral trade agreements between these countries. I'm talking about all the structure, all the financial institutional infrastructure that you need in order to actually be able to move billions or trillions of dollars of funds between one country and another. One payment network isn't sufficient. You need the legal
Hmm.
backing, the central bank currency reserve current management, right? The FX swap lines, on and on, right? So it's a whole set
Hmm.
of financial infrastructure that is required for it to actually execute. It's not just about sending about a payment system.
Okay. Okay. Uh, I
And
mean,
all
to me,
these
it,
countries,
it makes perfect sense to build a parallel system because you don't build it when you need it, right? So they have been
exactly,
building it. Uh, and
they
then
have been
eventually
building it.
one day there's gonna be a switch, I'm assuming. But I mean, the idea of that is, to me, it sounds really scary. Okay. To switch from a dollar denominated financial system like Swift, all this, to a different one. That's going to be very painful. I don't know. I don't know that we can do it like gradually and pain free.
I don't know because that
Yeah.
used to be my opinion,
Hmm.
but some facts remain, which is that the U.S. remains the global country for tech and startup talent. It remains the best place to invest money, to
Right.
IPO a company, to raise capital, to make a hedge fund. It remains the
Right.
best country to invest, uh, to where you have legal precedent and courts that will defend you as an investor
Right.
rather than scam you like most other countries
Mhm.
would. So
Right.
that doesn't go away, right? So you could
Hmm.
see the U.S. decrease its maybe its dollar position because now the
Hmm.
alternatives are, and the geopolitical questions and also the fiscal questions are making the dollar system less attractive. Yes,
Hmm.
but the U.S. could remain a major country for international financial and technological talent and
Right.
investment. Also,
Right.
it
One
will
one thing one thing does not eliminate the other. These are not mutually exclusive things, right? The US
exactly.
is a wonderful country to make money in, definitely. Right?
Exactly. It's the best
By
country to
far.
make money in.
Best country to make money. But those financial rails that dominate the world today do not reflect the actual state of the world of trade and commerce. And like in multiple levels, like things have
Exactly.
caught up after the internet, but the money situation is still lagging behind.
Exactly.
That's all.
Exactly. And the
Yeah.
theory here is that
Mm.
we could see over the next few years, and we're already starting to see so many signs that it could actually cross the chasm and go through an S curve, right? And we're just before the S curve movement. I do think that's very likely, right? And the U.S. could still, nonetheless, still remain highest GDP country in the world or the second, because technically China is in power purchasing parity. China is now about 50% bigger than the United States in PPP terms. In nominal, it's still smaller, but that is also because the whole global dollar system is is based in New York and Washington, right? So of course the U.S. has that conversion benefit. But if you look at real goods and real value of goods and services, China's economy is already way bigger than the United States. So yeah, definitely, the physical world has already crossed the chasm, but the monetary and financial realities is lagging behind. Will it catch up? That is the big question, and that is what we try to analyze in this podcast. But looking at the latest signals, it seems clear to me that the likelihood of that catching up and also crossing the chasm where we move completely to a multipolar world is just becoming clearer by the day.
It's inevitable. It's just a matter of when, from my perspective,
Right.
right? And the U.S. Treasury can try to resist it and defend and this and that, but they're swimming uphill or
Right.
upstream. Yeah.
We'll see, right? Because the
Yeah.
Plaza Accord
Hmm.
theory also like
Hmm.
has a lot of failures in it. Because remember, when the Plaza Accords was signed in 85, Japan was the second biggest economy in the world.
Right.
Germany
Right.
was the third. Today,
Things have
UK was
changed.
the fourth. France was the fifth. Right? Things have changed. Japan is now third or fourth. I think fourth. China's way beyond all the other ones, right? And India's catching up. Even Russia was at a very weak point in '85. Now way stronger. So the Arab countries basically were not present back then. Now they are, right? So things have changed. So can the U.S. if the U.S. gets an agreement with Japan, Japan, France, the UK, and Germany to devalue the US currency against them, well, the thing is that they don't represent what they used to represent in the economic value of the world. Now, will the US be able to get China in that deal? Probably not, right? And that makes the whole difference. Because if China is not going to devalue, it's not going to like is not going to agree to the US currency getting devalued versus its currency to help US manufacturing, which of course it
Mhm.
wouldn't,
Why
then
would they?
the other
Right.
countries are not sufficient to make that economic impact, right? Contrary to what they were in 85, where China was simply not figuring, it was simply not part of the top global countries. It was coming out of a major economic crisis. The Soviet Union was entering one, very different global reality. Also, fiscally, the US was in a different position, geopolitically too, right? That was the militarily too. So a lot of things are different, and I don't buy the Plaza 2.0 Accords because of those reasons, right? And something could be tested out, right? A lot of things will be tried out, but we will see, we will see. So I think that's enough. Do you want to add something else?
Uh, nothing in particular. Just this idea that this whole thing with the 30-year bond. I think it's only gonna get worse, and they doubled it from 2 to 4. I think it's gonna be way more by the end of this decade.
Yeah,
Uh,
I agree.
and we'll see where it goes.
Buy
Uh,
Bitcoin, buy
buy
gold.
Bitcoin. Buy Bitcoin while you still can, right? I see that there's gonna be a time when you cannot really like buy Bitcoin anymore. That you have to work for it. Because why would you sell your Bitcoin, right? It'll be easier to work for Bitcoin anyway. But
We'll see. We'll see.
we'll see
Thank
what
you, Claudia.
happens.
Thank you, everyone who listened. Please leave
Mhm.
us your feedback. That's always appreciated. Thank you so much for listening.